if you didn't think you had enough gold, if you didn't think you had enough silver, now you've got a pullback. Now you've got an opportunity to add to it. And if you were sitting on the fence and you never bought any gold or silver, well, hey, these lower prices give you a better entry point. They let you buy more gold and silver for fewer dollars. Even more so in the mining stocks. We've had a much bigger correction there because the environment for these stocks, even if the price of gold and silver were to fall more, these stocks are still ridiculously cheap. But I don't think they're going to fall that much more. And even if they do, they're not going to stay down. I think gold and silver are going to recover maybe even faster than they went down.
The recent pullback in the gold and silver markets presents a strategic window of opportunity for investors to accumulate hard assets at a lower cost basis. While the broader market remains fixated on short-term price fluctuations, the underlying value of precious metals remains intact, offering a superior entry point for those sitting on the sidelines. This correction is even more pronounced in the mining sector, where stocks have become remarkably undervalued relative to the intrinsic value of the metals they produce. Even if prices were to dip further, the structural demand for physical bullion ensures that any decline is likely to be short-lived. Peter Schiff, a renowned economist, global strategist, and outspoken advocate for sound money, views this market correction as a gift for long-term wealth preservation. He emphasizes that the current environment makes high-quality mining stocks look ridiculously cheap, providing massive upside potential once the recovery begins. Schiff anticipates that gold and silver will not only rebound, but likely recover faster than they fell. By taking advantage of these lower prices now, investors can secure more ounces for fewer dollars before the next major leg of the bull market takes hold. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
This week, gold prices collapsed by 10.5%. Gold closed the week just under 4,500, it looks like. We're now down almost 20% since the peak on Sunday, March 1st, is when I think gold retested about 5,500, somewhere around there. That's when the war started. The war against Iran started on a Saturday, February 28th. And initially, gold rose a little bit on Sunday night and held most of those gains on Monday morning. But since then, we're down almost 20%. Silver prices were down 16.5% on the week. We closed, I think, just below 68. To put the magnitude of these declines into perspective, I believe this is the biggest weekly decline in the price of gold since 1983. Silver, you don't have to go back quite as much because silver has a more volatile history than gold. But this is the biggest weekly decline in silver since 2011. In fact, silver is almost down 50%. It got above 120, not quite 50% now at 68, but over 40% from its peak. Now, gold and silver stocks, as you would expect, also got killed on the week with the GDX down 15.5% and the GDXJ down 17%. Now, obviously, depending on your perspective, this is either the worst week ever or since 1983 for gold or the best week. If you were planning on selling some gold, it was a bad week. But if you wanted to buy more gold, it was a great week. The same thing with silver, because I don't think this decline does anything to alter the fundamental case for gold or silver. In fact, ironically, the very catalyst for this sell-off actually strengthens the bull case. The bull case got stronger, not weaker, based on the data that sparked the sell-off. And the reason that the data sparked the sell-off is because the traders that are responding to this data have no idea what it means and don't understand what it portends. It all started on Wednesday morning, believe it or not, these big declines really started on Wednesday, not on Monday. But on Wednesday, we got the producer price numbers for February. Now, remember, these numbers don't include anything that's happened since the war started. Oil prices closed the week up again. We closed around $98 a barrel. We're up about 50% since the war started, not quite 3 weeks ago, during the month of March, 50%. None of this increase is in these numbers. And, of course, it's not just oil prices that have gone up. A lot of prices are going up. Food prices are going up. But this is all before. So the February producer price number, and I went over this on my regular podcast that I did on Wednesday, but I'm going to go over it again on this market wrap. But producer prices, which were supposed to rise by 0.3, which would have been an improvement over the 0.5 increase for January. Instead, they rose by 0.7. That is a huge number. That is a monthly gain. If you annualize that, assuming that prices went up by 0.7% every month, that's 8.4. You're almost at record inflation. I mean, based on their recent experience. Now, these are not consumer prices, they're producer prices, but they're a leading indicator of consumer prices. And their prices, they're being pushed up by inflation. But even if you just take the year-over-year increase, it's 3.4% as opposed to 2.9% the month earlier. So not only did the 2.9% not get closer to the Fed's 2% target, it moved a lot in the opposite direction. And it actually gets worse when you strip out food and energy. The core, which supposedly is more important, core prices rose 0.5% on the month, but year over year, 3.9. We're just a hair below 4%. That's double the Fed's 2% target. So this is really bad news. It's much worse news than how the markets received it, but it is not a surprise to me. My investment thesis all along, and I have reiterated this many times on my podcasts, on social media, on X, my thesis is that the Fed has it wrong, that inflation is not dead and buried, it's alive and well, and is coming back with a vengeance. Contrary to the claims of the Fed, monetary policy never got restrictive. It was always too loose. Every rate cut was a mistake. When the Fed started cutting rates in 2023, when the Fed funds was 5.25, 5.5, every rate cut since then, which has brought the Fed funds rate down to 3.5, was a mistake. We just had accommodative policy and we made it more accommodative. The Fed aborted the inflation battle prematurely because it surrendered. The Fed didn't win the inflation war. Inflation won. And the reason the Fed had to stop fighting is because the collateral damage started to be too high. Banks started to fail. Higher interest rates were taking a toll on the economy, so the Fed backed off. Because from the Fed's perspective, curing inflation was worse than the disease of inflation.
The precious metals market has just endured its most significant weekly decline in decades, with gold collapsing 10.5% to close under $4,500 and silver plunging 16.5% to near $68. This technical sell-off, the sharpest since 1983 for gold and 2011 for silver, was triggered by February Producer Price Index, PPI, data showing a staggering 0.7% monthly increase. When annualized, this represents an 8.4% inflation rate, a figure that does not even account for the 50% surge in oil prices following the outbreak of war on February 28. While traders panicked, the fundamental bull case for hard assets has actually strengthened as the reality of sticky inflation dismantles the hope for further monetary easing. This volatility stems from a massive miscalculation by the Federal Reserve, which prematurely declared victory over inflation. By cutting rates from 5.5% down to 3.5%, the Fed shifted to an accommodative stance while core prices remained double their 2% target. This surrender occurred because the collateral damage of high rates, banking failures, and economic contraction became politically and systemically unbearable. For investors, this correction is not a change in trajectory, but a final opportunity to exit a dying fiat system before the lag effect of record producer prices hits the consumer market with full force. Let's get back to the interview.
At some point, the markets are going to recognize reality. And when they do, they're going to go piling into gold, piling into silver. One of the interesting things about the week was the failure of the dollar to rally. The U.S. dollar index tried to rally. It did get above 100, got up to like 100.5, but then it sold off. And it ended the week pretty much where it began the week, at about 99.5. So that is interesting that we didn't get a big movement into the dollar. And of course, we didn't get a movement into the bond market. We got a movement out of the bond market. So people were selling bonds. Obviously, they were selling their gold, and they sold silver, they sold stocks. So what did they buy? They just went to cash. And some people went to their own cash. Europeans probably went to euros. The Japanese went to yen, right? Everybody didn't rush into dollars. They just sold whatever they had, including their gold and silver, and they just went to cash. Now, interestingly enough, Bitcoin held up pretty well. I mean, on the week, it was down about 5.5%, but it's still hanging out at 70,000 of Bitcoin. And I think a lot of people are looking at that and they're getting a false sense of confidence that somehow Bitcoin is acting as the new safe haven. If it was acting as a safe haven, it would have gone up. Now, yes, it didn't crash, but that's a big difference between going up. So money didn't flee Bitcoin, and probably because MicroStrategy just keeps on buying it, right? So he's putting a temporary floor, Saylor is, under the price of Bitcoin. But I think this is the lull before the next crypto storm. I think people who are reading into the fact that Bitcoin didn't collapse and thinking that's a good sign, I think they're just pressing their luck by hanging on to it. I think the next move in Bitcoin is going to be down. The real opportunity, I guess, for you Bitcoiners is that you can sell Bitcoin now and buy some gold and silver, because we've had a much bigger decline in gold and silver recently than we have in Bitcoin. Now, of course, gold is a lot closer to its high than Bitcoin, but still, we've had a very big pullback. It's a good opportunity. Remember, at Schiff Gold, we make it very easy for people to convert their Bitcoin into gold. We allow you to check out using BitPay. So it's one-stop shop for converting fool's gold into real gold or silver.
The markets are rapidly approaching a moment of forced recognition where the facade of a stable dollar finally crumbles. The recent failure of the U.S. dollar index to sustain a rally above 100, combined with a synchronized exit from the bond market, signals that global investors are no longer seeking refuge in traditional fiat safe havens. Instead, we are witnessing a raw scramble for liquidity where even gold and silver have been temporarily sold off to raise cash. While Bitcoin has maintained a deceptive level of stability around the 70,000 mark, largely due to corporate support floors, this should be viewed as the lull before a significant crypto storm. The true opportunity lies in rotating out of these intangible digital assets while their prices are still elevated and moving into the deeply discounted physical gold and silver markets. Converting speculative digital holdings into physical bullion at these corrected levels is the ultimate move for long-term wealth preservation. As the global natural audit continues and the reality of a 4% core inflation rate sinks in, the stampede into hard assets will be unprecedented. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.